Understanding mortgages, a comprehensive guide. Mortgages serve as a critical financial instrument, enabling individuals and families to purchase homes and other real estate without needing to pay the full purchase price upfront. This article aims to demystify mortgages, explaining their functions, types, and the process involved in securing one. What is a mortgage? A mortgage is a secured loan specifically used to buy or maintain real estate, including residential homes, plots of land, or commercial properties. The borrower agrees to repay the lender over time, typically through a series of regular payments that include both principal and interest. The real estate itself acts as collateral for the loan, meaning if the borrower fails to repay, the lender may foreclose on the property. Key takeaways. Mortgages are essential loans for purchasing real estate. The property acts as collateral. There are various types of mortgages, including fixed-rate and adjustable-rate mortgages. The cost of a mortgage is influenced by the loan type, duration, and interest rate. Mortgage rates can fluctuate based on loan characteristics and borrower qualifications. How mortgages work. Mortgages allow borrowers to acquire properties they may not afford if required to pay the total cost upfront. The borrower makes fixed monthly payments over a set term, generally 15 or 30 years, until the loan is repaid in full. For most traditional mortgages, repayments are fully amortized. This means that the monthly payment amount remains constant throughout the loan's life, with different portions applied to the principal and interest over time. Understanding the collateral aspect. The property secured by the mortgage acts as a lien. If the borrower defaults on the mortgage payments, the lender has legal rights to take possession of the property through a process known as foreclosure. The mortgage process. Application and approval. The mortgage process begins with the borrower applying through their chosen lender, who will require documentation to assess the applicant's financial capacity. This documentation usually includes bank and investment statements, tax returns, and proof of employment. 1. Pre-approval. Borrowers can select a property or apply for pre-approval, a process that assesses their eligibility, allowing them to act decisively in competitive markets. 2. Closing. Once an offer is accepted, parties meet at a closing session where the buyer makes a down payment, legal ownership transfers, and any remaining mortgage documents are signed. Mortgage lender options. Mortgages can be acquired from various sources. Traditional banks and credit unions. Mortgage-specific lenders. Online lenders. Mortgage brokers who facilitate finding the best deal. Types of mortgages. Understanding the various mortgage types can help borrowers make informed decisions based on their financial situations and long-term goals. Key mortgage types include 1. Fixed-rate mortgages. This type is the most traditional mortgage structure. The interest rate remains constant for the entirety of the loan term, providing predictable monthly payments. 2. Adjustable-rate mortgages, ARMs. These loans have a fixed initial interest rate, often below current market rates, which will adjust at specified intervals based on benchmark interest rates. Initial rate caps are typically in place to limit how much rates can rise. 3. Interest-only loans. These allow borrowers to pay only interest for a specified term, often leading to larger payments later on when the principal must be repaid. These loans carry more risk and require careful financial planning. 4. Reverse mortgages. These loans are tailored for homeowners aged 62 and over, allowing them to convert their home equity into cash without selling. The loan is ultimately repaid when the borrower sells the home, dies, or moves out legally. 5. Government-backed loans. FHA loans, designed for those with lower credit scores, allows lower down payments. USDA loans, targeted at rural homebuyers requiring low-interest loans with no down payment. VA loans, available to veterans and active military members, offering favorable terms and conditions. Average mortgage rates. The cost of a mortgage can vary significantly based on the loan type, term, discount points, and prevailing interest rates. Historic trends. Mortgage rates saw notable lows during 2020/2021, dipping below 3.5%. However, by late 2022 and into 2023, rates surged, breaking above 7%, a trend that continued into mid-2024, with fluctuations observed. Current rates as of July 2024. 30-year fixed-rate mortgage, 6.77%. 15-year fixed-rate mortgage, 6.05%. Comparing mortgages. With numerous sources available for obtaining mortgages, comparison shopping is vital. Online mortgage calculators can help estimate monthly payments based on various factors, providing a clearer picture of affordability. Additional costs, such as property taxes and PMI, if the down payment is less than 20%, should be factored into total monthly costs. Frequently asked questions, FAQs. Why do people need mortgages? Most homes are priced beyond the savings many families possess, making mortgages a practical solution to home ownership. Can anybody get a mortgage? Borrowers must meet specific qualifications based on income, assets, and credit scores to secure a mortgage. What does fixed versus variable mean on a mortgage? A fixed-rate mortgage has unchanging interest rates throughout the loan's term, while a variable or ARM features rates that fluctuate based on market conditions. Conclusion. Mortgages are fundamental to the home buying process for most individuals, providing a feasible method to acquire real estate without significant upfront costs. Understanding the types, processes, and financial implications associated with mortgages can empower potential homeowners to navigate the complexities of purchasing property and ensure that they make the best possible financial decisions.